Good afternoon, everybody. Welcome to FX's webinar on impact investing and tax reliefs. We are running the session today for an hour with some great panelists, and I'll be shortly introducing you to them. We've got lots of people signed up for the session today, so over a couple of hundred actually, which is really interesting. It's obviously a good time of year to be thinking about your finances coming into the new year and coming up to the end of the tax year. So everybody is well tuned to listen to this and take it on board. So welcome everyone. Yeah, my name's Lisa Ashford. I am CEO of FX and Energize Africa, two of the UK's leading impact investment platforms, and I'm joined today by Julian Parrott from Ethical Futures. Hi, Julian.
Hi.
And James Dickens from Grierson Dickens, sorry. And they are two IFAs that we have worked with over the years and are within our trusted network. And also today we have Charlene Cranny, who is founder of Economy for Good, who likes talking about all things about good money and how that fits into an ethical lifestyle. So welcome, Charlene. It's great to have you.
Thank you.
For those of you who are eagle-eyed, you will have noticed that we were supposed to be joined by Sam Dawes today, who is a FX and Energize Africa investor, but unfortunately, he has been struck down with COVID, so he won't be able to join us today. Apologies. We were saying that we might try and run a second webinar, which gets the inputs from a number of our investors, which I think might be useful. But in the meantime, we will be cracking on with today. And just to a bit of housekeeping, we will be running for an hour. If you would like to submit any questions to us, please do so via the chat function. I will try and pick these up and feed them into the conversation as we go. Also, just to say that nothing on this webinar can be treated as financial advice. We can't answer any specific questions about your own personal financial circumstances. We will be sending out some further resources after the event, and I'm sure James or Julian can also, and Charlene can point us to some useful resources as well. So let's kick off, shall we? So first of all, let's just raise the question to start with. Why does the government offer tax reliefs on certain types of investment offered, and how can they benefit both investors and the planet and our communities? Well, if I can just kick off on that one. As we're going to talk about during the session today, there are a number of different tax reliefs which are implemented by the government for some quite specific reasons. So we're going to be talking about the Innovative Finance ISA, which is one of the components of the well-known ISA tax relief products, which is available to everybody. There is also lesser known tax reliefs such as EIS and SEIS, and these really were introduced by the government to help small, early stage, higher risk organizations raise finance and to help mitigate some of the risks associated with investing in those types of businesses for investors. And then alongside that, we have quite similar social investment tax relief, which is similar, but is specifically for social enterprises. And it's to really help get investment and for those types of businesses to be able to raise finance. And lastly, we have CITR, which is quite niche. That is only community development finance institutions can use that particular tax relief. And that was introduced to help particular communities raise finance for businesses in underserved areas where they might not be able to raise finance from mainstream sources. So there are all of these different elements that can be applied to different types of organizations for different purposes. But they can be really useful to individual investors and in some cases organizations when they're thinking about impact investing. So James, perhaps you could tell us your perspective on how your investors have or haven't used tax relief as part of their overall plan and how impact investing fits into that.
Yeah, sure. I suppose that the government offers this tax incentivized schemes to encourage people to invest in enterprise. So startup businesses, whether they are impact orientated or not, but in this case we're talking about impact orientated businesses. So essentially it enables someone to invest in an organization that is normally in its infancy in terms of SITR or EIS, which will carry out some sort of trade, will be some sort of business, but where the investor is being given a tax incentive to invest in it. And that tax incentive might be where you get some a reduction in your tax bill as a consequence of investing, for example, with SITR, and therefore the net cost of investing is less than the amount of money you put in if you qualify for the tax relief. And then there are other benefits. So if it goes wrong, you can claim loss relief, and if it performs well, then the capital gains tax liability is mitigated or sometimes eliminated. So it's all about encouraging enterprise in return for tax benefits which reduce risk. And on the other hand, where you've got things like an ISA, it enables you to hold investments in a tax privileged environment so that you can invest in a social enterprise and pay less tax, essentially. I think that's pretty much it, unless anyone else has got anything else to add to
that. Julian?
No, I mean, I think you're right. I mean, you know, you could have, as an investor, you could have a motivation around sort of managing aspects of tax, and some of these investments will help you in terms of that area. But I think it's in, as you say, it's in areas where perhaps there's slightly less familiarity away from the world of sort of standard funds and stock market investments. It gives people that extra financial incentive to focus, and for those people that are more socially, environmentally, and impact motivated, it gives a structure which can still deliver a reasonable investment return without pushing the company to, or the organization to, have to sort of maximize financial return to the investor without you know, and putting the project at jeopardy, if you like. So it's not a subsidy, but it's a way of perhaps managing the level of return on the investment, and that can make it more attractive as a proposition in the first place.
Yeah. And what about the philosophical question somebody's come straight in and asked, which is, I think, really pertinent, is, do you think there's a loss of intentionality if people are investing for tax relief? If that's their, you know, do you often see people who are investing for that alone? Or, you know, are they actually, well, they're really investing for the impact and the tax relief is the cherry on top?
well, for us, the name of the business is Ethical Futures. So our clients tend to have that intentionality when they come to us, that they have an aspiration to make some impact with their money. So so no, we don't really get led by that, and I'm sure James is similar philosophy, that you don't let the tax tail wag the investment dog. You have to have a clear and reasoned consideration for why you're making the investment in the first place.
Charlene, how do you, what's your view on that more philosophical question?
Yeah, I mean, when people are starting out in ethical finance, that I'm seeing, I'm really speaking to the beginners, and they are looking for the impact, and they're finding that there are these sort of tax reliefs that are available to them. And that does feel like the cherry on top. But yeah, I'm speaking to a particular type of investor. They're beginners, and they're really just looking for those impactful opportunities.
Yeah, thank you. And Julian, who is eligible for tax reliefs? Can you give us an overview of how that all fits together?
Yeah, no, certainly. Predominantly, it's individuals. There are CITR has an option for companies to benefit from as well, but predominantly it's individuals, and predominantly these are reliefs on income. So whilst it might seem obvious to state it, it's worth pointing out that you do have to have a taxable income to be able to claim the relief. So there is a technical point about that. I think it's useful to put them in the kind of landscape of allowances. I mean, as under the tax regime, we all have an entitlement to standard allowances. We can earn £12,570 of income without paying any income tax on it. We also now benefit from savers allowances of £1,000 for a basic rate taxpayer, £500 for a higher rate taxpayer, on interest that we earn on investments. And these can apply to investments that you can find on FX and other similar platforms. And you also can receive dividends of £2,000 tax-free as well. So there are a variety of allowances there. You can invest £20,000 in the total ISA allowance, of which the innovative finance ISA can be all or a component of it. So because it can also cover cash and stocks and shares. I think the useful thing to understand is the difference between allowances and reliefs. Allowances are generally around an amount of money that can earn some sort of treatment or benefit. So £20,000 in an ISA will be exempt from income and capital gains tax liabilities. Whereas I said before, reliefs are reliefs on things that you have. So reliefs on income or reliefs against capital gains, etc. You have to have that liability or that income in the first instance to be able to benefit from it. So as you build your pot of investments, these are really useful additional features which allow you to go over and above, the sort of core allowances, and the government is encouraging you to do it. It's an incentive to invest and be productive with your money is their aspiration.
Thanks, Julian. So let's get into the nuts and bolts a little bit. So we're going to first look at the IF ISA, which is the Innovative Finance ISA. And this is something which is utilised on a number of crowdfunding platforms. It's quite helpful because those platforms can often have a low minimum investment rate, so it's quite accessible. For example, on Energize Africa, the minimum investment is £50. So that allows quite a wide range of individuals to be able to access those types of investments. So Charlene, can you just talk to us a little bit more about what you know about the Innovative Finance ISA and how it's used?
Yeah, so as already mentioned, it's another type of ISA which counts towards the tax tax-free allowance of £20,000 a year. And it's different to your cash and stocks and shares ISAs in that the savings made into the innovative finance ISA are used to provide direct loans to businesses, projects or individuals for an expected but not guaranteed return, and also generally for a fixed term. So you'll want to be happy with leaving the money alone for a while. But many platforms allow you to buy and sell the loan that you've made to someone else if you need to access that money sooner. And what's great about lending directly to businesses and projects is that you choose them. It gives you, this type of ISA gives you full say in where your money goes and what kind of positive impact you want to have. So some example projects include affordable renewable energy, supporting nature and rewilding, supporting people with mental health. There's such a range, and yeah, there's quite a few platforms that all offer this, and it's quite fun seeing what new projects and businesses come up and the types of positive impacts they're having.
Thanks, Charlene. And I think what we were having a discussion earlier, that a number of the clients that might go to James or Julian, for example, might have perhaps a bit more money that they're looking to have some support and be advised on where they place that money. I think from our point of view, the IF ISA is quite often used by people who are a bit more self-directed, and it's not necessarily used by people who have perhaps a really high net wealth that they're using for investing, but perhaps you could say that it's for more everyday type investors. And just a sort of bit of data of our investors on Energize Africa, where all of the investments are IF ISA eligible. It's about just under 50% of those investors utilize the innovative finance ISA, so almost 50-50, which I think is quite interesting because they get to benefit from that interest in a tax-free environment, obviously depending on own personal financial circumstances. And as you say, it can really help some of the more grassroots organizations as well. And, I'll come back later to an example of one of the projects on ethics, which has been utilizing the innovative finance ISA. And that is a community energy scheme, which is community benefit society. So you can get these social enterprises utilizing these tax incentives to help get more grassroots support into their projects, which is really good. So let's move on to EIS, so the Enterprise Investment Scheme, and SEIS, which is the Seed Enterprise Investment Scheme. And James, you were going to just talk to us a little bit more about that.
Yeah, sure. And apologies to Judith, who said if someone is going to describe the different schemes work, because I went straight into acronyms rather than describing it. So EIS and SEIS. So EIS stands for Enterprise Investment Scheme, and or Enterprise Incentive Scheme, and it's there to incentivize an investment in a new enterprise, as the name suggests. So the key facets of it are you are investing in a single share in a single company. Okay, so it's not diversified. You get a reduction on your tax bill of up to 30% of the amount you invest. So to use a worked example, if you invest £10,000 and your tax bill is £20,000, you'll get a reduction of 30% of £3,000 on your tax bill. That's it, as simple as that. But as Julian said to you earlier, if you don't have any taxable income, then you don't get the reduction in your tax bill because your tax bill is 0. So you invest in it, it's a single company, you get this 30% tax reduction, and then you have dividends are taxable, but they're unlikely to pay dividends because they're an early stage company. When you sell the investment, you don't pay tax on the capital gain. There are some other nuances of EISs, but that's largely the bones of it. But the key point here is that it's a single company. You are investing, you're buying a share in a single company. And companies that do EIS schemes are normally at very early stage of investing, very early stage in their development. SEIS, by slight contrast, is for even smaller businesses. So for a lot of businesses, it's the very first way which they raise capital, and it's very similar to EIS, except the amount of reduction in tax you get is 50% of the amount you've invested to reflect the slightly higher risk. It's all about startup businesses, single shares. So the benefits are the tax benefits, the downsides are the risk. Just to add one further thing, if the investment goes sour and you lose all your money, or you lose part of your money, you can then claim loss relief, which I won't go into because it's a bit fiddly, but it further mitigates the risk, because the amount of money that you will lose will probably be less than the amount you invested.
Thanks, James. Lots of questions coming in now. What I'm going to do is we'll go through each of these categories, and then I'll stop and take a number of the questions so we can answer them now, and then we can move on. Julian, can you tell us a little bit more about SITR and CITR, please?
Yeah, certainly. So social investment tax relief was brought in 2014, and it largely builds upon the fundamentals of the enterprise investment scheme basis, although it does have some differences, and therefore you can't read across directly. But its purpose is to provide an incentive to invest into social enterprises and the trading arms of charities and businesses that are working with a social impact. So the businesses do need to be accredited with assessing having a social impact, and therefore they will quite often relate to certain sort of structures such as community benefit societies, community interest companies, and such like. The allowances, as I say, are similar. I mean, you can invest in total up to £1 million in SITR funds, maxed at 250,000 per investee. There's the main relief is the 30% tax relief, again exactly as James explained on the initial investment. And the mechanism for that is that once money is invested, you'll get a certificate back from the revenue, and you can then use that to claim against your tax relief. There's the ability to defer capital gains tax gains, so you can't avoid, but you can defer a liability on a gain. And although a lot of the investments are mostly into what we call bonds, so loans to organizations, it is feasible to have an investment which in SITR, which is into shares and equity of an organization. And if that was the case, then there might be some IHT relief, but and then the loss reliefs are similar. Key things are you need to hold the money for 3 years before you can get your money out there. As I say, there can be income arising, certainly from a bond. There could potentially be income arising on an SITR qualifying investment. And that, funnily enough, is not tax-free. It's the income isn't, but the relief on the investment is. And Predominantly, it will be direct projects, again, as James explained, into particular ventures that are going there. But there have been a few funds which or investment houses which have created an investment which then invests across a number of different SITR qualifying activities, and therefore that allows you to sort of spread your risk. CITR is not dissimilar in as much as its particular focus is around community. So it's community investment tax relief, and therefore it's a particular focus on supporting activities in disadvantaged communities. That is eligible to businesses to invest in as well. An investee company has to be what's called we love acronyms in financial services, CDFI, so a Community Development Finance Institution, of which there are apparently 33 in the UK. There's quite a big one just up the road from me and from my offices in Edinburgh. And they can either be wholesalers who then lend on to other organisations, so they can issue themselves, or they could be investing directly. Again, same sort of investment underlying it, sort of bonds and equity, but there are occasionally some deposit takers, some lenders who will offer a CITR deposit account, so you can get tax relief on the money you've got in your deposit account. And the way it works is basically, again, they generally have a sort of 5-year term or a 5-year period of investment. You can gain 5% tax relief per annum that you hold the investment. So 5% of the money you're putting in can be used to claim relief against your income for that year, and interest possibly would be payable on those deposit accounts as well. So that's the joys of CITR and SITR.
Thank you. And just an example of a project which is CITR was Art Business Loans, which some of you might know was a Birmingham-based CDFI who raised on the platform, I think the year before last, and did very well. And I think it was the first time that we had really raised finance for a CDFI, and so people were still sort of getting their head around what that type of organisation is and what's the tax relief. And we did write a blog on that, actually, so we'll make sure that that gets sent around again, because I think it's quite useful to look at a sort of tangible example. And then I'm just going to come to some of these questions as we go through. So forgive me as I just run through them. So Energize Africa, all of the investments on Energize Africa sit within the Innovative Finance ISA. They're all eligible because it's a standard debt product. Someone said, why would people not use Innovative Finance ISA? Because I said 45% of people do, and obviously 55% of people don't. Probably because they might have another ISA elsewhere within the same year. And that speaks to someone else's question, was can you have more than one per year? And correct me if I'm wrong here, you can only have one ISA per year, but you can split your ISA between different categories. So you can have some of your 20,000 allowance in cash, some in stocks and shares, for example. If ISAs are transferable, or your allowances can be transferred between platforms, and there's normally a relatively efficient process for doing that. Another question. I think we've answered that one. Julian or James, you mentioned about inheritance tax, which was on, can you just James, was that you?
I might have mentioned inheritance tax. I'm happy to cover it if that helps.
Yeah, could you?
Yeah, I noticed Daniel has said, do any of the schemes help with inheritance tax? And that's generally down to the underlying investment, because if you invest in a trading business, so a business that does something that's not quoted on the main stock market, so not in the FTSE 100. So to use the jargon, an unquoted trading company. Normally, if you hold those for 2 years, then they are exempt from inheritance tax. So quite a lot of the impact investments that we've done for clients would qualify as unquoted trading companies. But I think, and maybe Julian, sorry to ask you if I'm wrong, if you're in an ISA, then no matter what the underlying investment is, I don't think it would qualify for that inheritance tax exemption. Would you agree with that?
Yeah, no, I'd agree with that. I would also just caution that inheritance tax is predominantly a tax that's paid on debt, and we might well be talking about an investment that's got a 5-year timeline. So whilst it might theoretically qualify under business relief, which is the relief that James referring to for the small trading company, you might have cashed in the investment by the time and recycled it into something else that was relevant and appropriate. So yeah, which is the reason why you should invest for purpose and objective and term first, and tax breaks second.
Yeah, thank you. There was a question about whether withdrawable shares could be held within an IFISA and whether that was likely. That's currently not possible, as someone has commented. I know withdrawable shares for community benefit societies or cooperatives do have similar characteristics as debt, but at the moment they are not eligible, and I haven't seen anything which would indicate that that would change. Bear with me. Can you carry tax savings to future years if not paying tax in the year of investment? Julian?
You can carry it back, you can't carry it forward. So if you had a higher tax bill last year, well, this isn't 100%, but in most cases this rule would apply. If you had a higher tax liability last year and you're investing this year, then there's theoretically the ability to apply the tax relief to the previous year.
Okay. Thank you. For Energize Africa, does the whole portfolio sit within the IFISA on an ongoing basis, or does each reinvestment count as a new investment which draws down my ISA allowance for the current year? So I think the question is, you have a limit of £20,000 for the year, unless you've transferred in previous ISA allowances, and you can invest in that, and then as long as the interest and capital comes back into the IFISA wallet, it continues to sit under that umbrella. So hopefully that answers your question. Good. Okay, well, there are lots more questions coming in. I'm going to take a break from the questions just for a minute, because I want to give Charlene a chance to talk as well. But what I did want to, we'll come back to those in a moment. What I did want to ask those people listening is, how easy is it to understand from an investor point of view, what the different tax reliefs are for these types of social or impact or community investing? And do they do they actually influence your decision on whether to invest or not? So feel free to write your response in the chat function, and we'll come back to those and see what the general flavour is. And Charlene, excuse me, coming to you, the types of ethical investments that qualify, you know, under particular tax reliefs, we have community or ordinary share offers. Can you talk to us a bit more about the different types of organisations and what they look like, and community versus ordinary types of companies limited by shares, and how you see those within the impact space?
Yeah, so just really kind of focusing out a bit and just trying to simplify this for some of the beginners on the call. So the difference between an ordinary or a common share and a community share is that you can typically buy and sell individual ordinary shares in listed companies like Apple or Costa Coffee from and to other investors on a public exchange quite quickly, which I wouldn't consider without an advisor if you're a beginner. Whereas community shares are issued by community-led organisations such as cooperatives, and they typically kind of issue those shares on platforms like FX and Triodos crowdfunding, also Abundance. And the purpose of those is to raise money for local facilities such as energy, affordable housing, or community farms, or whatever is going on in that community that they want to produce to help make it a more kind of resilient, sustainable community with kind of, you know, and support well-being as well. There'll be things like mental health projects and stuff like that. But rather than sell those community shares to other investors, you typically ask for a withdrawal of your cash to retrieve your money. But you'd want to look at the terms, because they might say that you have to stay invested for a while first. And when you buy community shares, you may be eligible for, you know, different types of tax relief. So the schemes that we've already talked about are the Enterprise Investment Scheme, EIS, which is the largest one, the Seed Enterprise Investment Scheme, SEIS, which is only for the new enterprises under 2 years old, and the Social Investment Tax Relief, SITR, which we've been talking about, which is only for certain types of social enterprise. So you should always ask if their share offer is eligible for any of those tax relief schemes. So those community share offers, they're just a really great option if you want to have a direct impact on community opportunities, well-being and regeneration, and also access those tax relief schemes that are available.
Thank you, Charlene. And Julian, what types of James, I'm going to come to you. In terms of bonds or debt products, how are they used within the sort of impact investing space? And do you see that commonly used?
Yeah, I think the whole bond thing is really interesting. So let's say, for example, a group of people see an opportunity to capture some wind energy. Then in order to get that going, they might set up an organisation and issue bonds, which is essentially them borrowing money from other people in order to get this thing off the ground. So in terms of borrowing money, there are various ways that you can do it. Let's say you set up, I don't know, Oxford wind generation farm, whatever. And you can either go to a bank, a normal bank, and borrow it, but that can involve quite a lot of hassle and cost. You can go to some larger UK organisations that will lend money to such startup businesses, or you can simply, I'll say simply, but you can go to like-minded people in the country who have perhaps got money sitting in the bank doing very little, want to do something useful with their money, and say, we would like to borrow your money, members of the public, to start up this organisation. So they will issue a bond, which, for example, might say, we'll borrow your money, we'll pay you 4% every year for the next 5 years, and then we'll give you the money back. Okay. And typically we see that for a lot of renewable energy projects, a lot of which have come through FX. And if the project is in its very early stages and is slightly experimental, there was a scheme to put a generator in a lock in Scotland to generate from tidal power, then the interest rate that the organisation will have to pay to the investors is quite high, because of course there's a chance that the organisation might fail and not be able to pay the bond back, pay the capital back at the end of the term. But with less risky projects, such as maybe a wind or a solar scheme, because it's always going to blow and it's always going to be sunny, the rate of return can be lower. So it's basically a way of borrowing money from like-minded people in order to get a very positive project off the ground. And sometimes these bonds are repaid from the proceeds of the business. Sometimes they're paid by refinancing, because once a business is underway, you can go out to the public again and say, right, this is now operational, so we'd like to do a refinance of the bond and perhaps pay at a slightly lower rate. And in my experience, it's worked very well, obviously not without risk. So it's great to be able to get a return whilst supporting a positive project.
Yeah, thanks, James. And I think a really interesting point, or important point, which, you know, should be just reiterated, that, you know, a higher interest rate generally does apply to higher risk investments. And so, you know, there is no free ride here. You know, risk and return are very much linked. So someone made a comment about the interest rates on Energize Africa. They are generally higher because, you know, you're investing in emerging economies in early stage organizations, and so, you know, that is high risk. So a couple more of the questions, let's see if we can answer. So someone said, so let me just catch a few of these. Okay, Julian, to you, are the ISA separate from stocks and shares ISA? So you can have a 20,000 limit on both?
No, no. So ISA, individual savings account, is a £20,000 a year allowance. You can put £20,000 into that in any 1 year. You can do that all into an ISA, all into a cash ISA, or all into a stocks and shares ISA. So those are the limits. The rule that you mentioned earlier on, Lisa, each of those providers that you have an investment with will be in the jargon term will be called a plan manager, and you can only have one plan manager for every type. So you can't have 2 different building societies cash ISA, or 2 different stocks and shares ISA, or indeed 2 different platform ISAs. But you can have one of each of them a year, so long as it doesn't exceed the £20,000 that you put in. And another thing which I occasionally find that clients sometimes misunderstand is, it's just what you put in. We hope it grows. So if it grows to £40,000, that's not a problem. It's you know, it's only the subscription limit, which is the £20,000.
Yes, thank you very much. I think I didn't quite hit one of the answers right earlier, which was you can only apply the ISA as you are investing. So you can't take historic investments and move them into a new ISA, for example. So if you'd already invested 2 years ago on Energize Africa, and this year you opened up a innovative finance ISA, you couldn't move the old investments into that. It's only for the new investments that you make under that if ISA, if that makes sense.
Yeah.
Hopefully it does this time. Good, someone's still completely in the dark. I'm very sorry about that, Judith. We will try and remedy it. And I think someone's asked for a clear fact sheet without acronyms, which we will inevitably, we will try and do. If we don't already have one, actually, I think we might do. So leave that with us. Do people find it easy? EIS is easy. SITR is easy. ISAs and any liquid assets, very hard to identify authentically sustainable and impactful funds for stocks and shares ISA. That's a good point. Charlene, what about the, obviously impact investing is becoming so much more mainstream now. And there are plenty of ESG funds popping up left, right, and centre. How do people navigate their way through that to really get to the impactful investments?
Yeah, I mean, I suppose it depends on what your definition of impact is, because I actually don't think impact investing is becoming mainstream. So the UK Investment Association, their figures are that sustainability themed and impact investing combined only makes up about 3% of all assets under management in the UK. Whereas it's ESG, that's the bit that's mainstreaming, and that's 49% of all assets under management. And the issue
ESG is, I'm going to have to pick you up on use of acronyms there.
Yeah. So environmental, social, and governance investing. So that's a strategy which oversimplifies it, is used by investors who have raised performance expectations of traditional companies, including on risky environmental and social behaviours. But my classic example that I always give is that a tobacco company can have a high ESG score because it is saving water and using it more efficiently than its peers. They might be treating their workers better than its peers, and lots of other things. But ultimately, it's still producing a product that kills people. So for proper social and environmental impact, it is that 3% that we need to grow of the sustainability and impact themed type investments. We need to grow that, but it isn't easy to tell the difference. I think that's why people assume that all of this good investment is growing, because of marketing, and there is greenwash out there. It's a wild west because we don't have clear definitions. The UK government is looking at labels. So that could be an exciting development if they do that well. And they're also looking at a green taxonomy to define exactly what providers can call green and what they shouldn't call green. But in the meantime, while we're waiting all of this for all of this, depending on which types of investments we're talking about, there's a couple of things that you can do in the meantime. So asking providers to give you a full list of your investment holdings to see exactly who you are profiting from or lending to, if you don't know that. Look at how your provider is talking about how they're achieving a positive impact, like how are they proving that? How are they showing that to you? Maybe look at their investment range. Is all of it committed to positive impact, or is it just one or two options? You can see the level of commitment there. And also, are they talking about some environmental and social targets that matter to you, such as reaching net zero or diversity and inclusion, gender equality, animal welfare, all of those things. So you can really kind of get to grips with whether your provider cares about the same things as you. So I guess that's a place where you can start to get a good idea about the impact of your money and what's really happening with it.
Thank you. That's super helpful. Okay, so we're going to talk a little bit about risk. Just bear with me. I thought this was quite interesting from Vivian. It's taken a bit of time to get my head around, but I think I finally got there. Does it affect my willingness to invest? Principally in two situations. A, when the investment is quite high risk, EIS and SEIS help to mitigate the risk and make me more comfortable with the investment overall. And B, I'm happy to accept a lower interest rate on a bond if I can hold it in an ISA because the interest isn't taxable. So I think that's quite interesting. One other question. There was another question on risk I wanted to pick up on. Hold on, there's so many questions to get through them all. Oh, there's a good one. Would the panel care to discuss the risk of the investment not achieving the impact it's looking for? Haha, Julian, you nodded.
Well, indeed, yes. Well, I mean, there are, well, there's two things. One is the investments to qualify for these reliefs, particularly the SITR and the CITR, do have to kind of be accredited and assessed as being as having a demonstrable sort of social or community benefit. But they can still go wrong. I mean, there can be things that go wrong, and what you will find in some investments is that there are metrics which influence that. So there are impact investments which might benefit from SITR, for example, that operate on a payment by results basis. So they're sort of upfronting some money to make some social change, and usually a governmental organization or something might pay a reward, a payment on achievement of certain outcomes. And if those are not achieved, then then that could be failed. I mean, there could be other reasons. James explained, the business model just might be challenged. But so there is a risk of achievement of it not being achieving a real social impact. But I suppose there are mitigations in there in the structure to try and give some assurance about purpose and mission of the investment.
Yeah, and certainly sort of from our perspective, it's a very core part of why we agree to list a specific community or business on the platform, because the impact is really central to what they do. It's not an add-on. So, if they don't achieve the impact, it's because the business has effectively underperformed or failed. And to someone's question about, well, how much do businesses fail who use EIS or SEIS? I'm not sure if there's specific data on that, but I mean, just in terms of, I do have some factoids to hand about, which was from a Community Shares report, actually, which says 42% of new companies make it through to the end of year 5, which is obviously, a lot of new startups do not make it. But quite positively, in contrast, 76% of co-op startups are still flourishing after reaching that same milestone, which I think is interesting, because it, I would argue, tends to reflect the fact that perhaps they are raising more patient and flexible finance, and it's investors like FX investors who provide that and see that impact is extremely important and central to that organization's existence, and that's why they're investing primarily. Okay, just clarifications again. Sorry, we just go through this one again. Can I put 20k into one ISA this year and 20k into another ISA next year? Yes, you can. Just to clarify what Julian said, it's my understanding you can have more than one ISA of the same type, but you can't contribute to more than one of the same type in the same year. Is that right?
Yes.
Yes, good. Full points to Vivian. Okay. Question to Charlene. Are providers obliged to disclose everything you have invested in? For example, on Hargreaves Lansdowne, I can only ever access the top 10 for stocks and shares ISAs.
Yeah, I mean, I don't know about this sort of legal duties for them to provide it, but they're not providing it at the moment because not enough people are asking them to provide it. And actually, for some of these funds, it could be a fund of funds. So we could be talking about thousands of companies, and they haven't worked out how to kind of format that and share it with customers. I mean, right now, it would probably look like a massive sort of Excel spreadsheet. But I think you should just keep asking for it. They need to figure it out. You should be able to access the information. And there are lots of platforms that are providing it and are figuring it out because they know that this is becoming more and more important to their customers.
Yeah, thank you. For a well-intentioned novice, how do I map the landscape of potential entry points, compare the market for ISA platforms? Well, I would say there's a reasonably good amount of comparable reports on that now in terms of impact investing. So Good with Money is one source. Do any of the panel have other sources that people should go to? Ethical Consumer also does have a number of comparable reports. Charlene, is there any other sources of information people should go to that you know of?
I think you mentioned them all. I mean, my favourites are Good with Money. And also, I am producing lots of great video interviews with people right across the industry. So follow me as well. Not to plug myself, but yeah, there's not a lot out there. So actually we need people providing information.
Yeah, thank you. And, you know, I think there's a number of the sort of broadsheets tend to have around this time of year. Perhaps they might focus a bit more on the mainstream providers, but do have generally a number of ISA eligible products that they write about as well. Okay, more questions. Can you make two different investments that are both eligible as innovative ISAs and don't exceed 20,000 in total? Yes, if it's within the same ISA manager within the year. I think that answers the question, hopefully. Good. Does anyone have anything to comment on VCTs? Would have to be a very quick comment, or should we leave that for another webinar?
It's a very, very, very limited market in a social impact environment. I think I only know of one.
Agree with that. Probably another discussion, but I'm with Julian there. Very little going on.
Okay. And James, when and how, when should people ask for advice? You know, how much can they be self-directed, and what's the point at which they should be looking to speak to someone?
I think it's got to do with whether you want somebody to take a holistic view on your finances, because financial advice is it is actually quite complicated to provide. I mean, theoretically it should be simple, but it's not inexpensive, and it's and for an advisor there are a lot of rules, quite rightly, that one needs to adhere to. So I think I would probably encourage people to have confidence in their own self-direction, because there's an awful lot of resources out there on the internet to help people make good decisions. I would always say to people, just make sure that when you're investing, you consider the potential for loss on that money. So in the past, I think we've had sometimes people have come to us and said, you know, I've got an amount of money, I want to invest half of it in impact. And I'm thinking, ooh, no, it's too much. If you do want to go, if you do decide you want someone to holistically review your finances, then I'd suggest asking friends, family, trusted people, or you can go to various organisations, the Personal Finance Society, and which don't need people to pay them money to be included in their search. And I think that's a really key thing, because there are some organisations where, as an advisor, if we haven't paid them any money, we won't have prominence in that search. So just be aware of that. But friends and family are the best source, I think.
Good, thanks. Julian and Charlene, anything else to add?
No, but I mean, it's just so great to see so many people on this webinar, and it's just so great to see people actively learning about this stuff, because it is so important and it has such an impact. It's so, you know, pensions, for example, 21 times more impacts than recycling, quitting meat, quitting flights combined. So your money does have a real impact. So it's just good to see so many people here.
And yeah, I mean, I would just echo, well, I'd echo both comments really. James's comment about advisors increasingly are in a position to help you put a perspective and a planning perspective around why you're doing things. But there is ample information out there if you want to try and do DIY, and I think, you know, you demonstrate that happens a lot. I mean, I think the only thing I would say is, you know, we've talked a lot about tax, and it's all about the breaks and this, that, and the other. Fundamentally, controlling your money should be about choice. What's it going to do for you? Where do you want it to be invested? But you need to ask yourself two questions about, you know, does XYZ investment meet all of those objectives? And it's therefore about compartmentalizing perhaps how you manage your money to achieve those objectives. But purpose and mission should be at and term and tolerance of risk should be at the forefront, and then the tax is a nice add-on to make it.
Great, thank you. Wise words to finish with. Thank you very much for bringing it back to impact. I think that's really important. Thank you everyone on the panel for your contribution today. Had a lot to get through, which is quite speedy in an hour, so thank you for that, and thank you for everyone for contributing who was listening in. This is recorded, so we will post it so you can listen back, and we will send a follow on email, which hopefully will have a few extra resources for you as well, and hopefully another follow-up session as well. So thanks everyone, appreciate your time, and have a good afternoon.
Thank you.
Thanks then. Bye.
Bye.